Hello, and thank you for joining us for this month's market update. I'm JP Powers, Chief Investment Officer at RWA Wealth Partners. There's a lot going on in the world right now, so let's start with where markets stand. U.S. equity markets are once again moving back toward all-time highs. After a brief but meaningful pullback earlier this quarter, you can see the strong rebound across both the S&P 500 and NASDAQ. And with it, investor sentiment has turned more broadly positive, particularly around technology, but also in the industrials and consumer sectors. That's good news for U.S. investors, but the real winner this year continues to be on the international side, highlighted here by the MSCI EAFE index, which includes Europe, Asia, and the Far East. Now, that momentum has been disrupted by renewed conflict in the Middle East. Despite some progress at this time, the situation there remains deeply concerning, and our thoughts are with everyone affected by these latest events. While the headlines are intense, markets have begun to price in the likelihood that the broader economic impact may be contained. The most direct market reaction has been seen in oil prices, which have jumped higher in response. But outside of energy, the ripple effect on global financial markets has been limited so far. But those oil prices matter, and not just at the pump, but also as a component of transportation, manufacturing, and global pricing pressures. In the weeks prior to these events, lower energy prices had actually been keeping inflation in check. That has quickly reversed, and now, paired with these ongoing tariffs, higher oil prices could mean headline inflation becomes more of a concern in the months ahead. If that turns out to be the case, it would have clear implications for the Federal Reserve as they consider any policy adjustments to interest rates. For now, the Fed has chosen to keep rates on hold, which was widely expected this week. Despite fears of instability, the Fed appears confident in the labor market's strength and sees enough support in the economy to avoid cutting rates. For now. They'll be watching the impact over the summer from tariffs, higher commodity prices, and these geopolitical developments. But the current stance suggests patience, waiting for more clarity before making their next move. That might take us well into the second half of the year, which is not great news for anyone looking to take out a loan or refinance existing debts. Elsewhere in Washington, attention is turning to tax policy. I hope to be able to cover the administration's so-called Big Beautiful Bill in more detail on our next update, but for now, several big-ticket items remain up in the air. While we have confidence that a tax package will ultimately get through, there can be no doubt that it will negatively impact an already bloated federal deficit. With this on the horizon, one question we've been getting more frequently is whether U.S. Treasuries still serve as a reliable flight to safety asset. Historically, Treasuries have been the go-to investment in times of uncertainty, as they're backed by the full faith and credit of the U.S. government. That certainly still means a lot, but in recent months, that relationship has become less predictable, with Treasury yields remaining elevated even during equity volatility. It's fair to ask whether something has changed. Part of this may be about saturation. Global investors already hold a significant amount of U.S. assets. And with questions swirling about deficits, supply, and future Fed action, some are looking elsewhere for diversification, particularly to other markets overseas. You can see that by the move in the dollar this year, as capital has shifted to the euro in a big way, causing the value of the dollar to decline, though we're still well within that 10-year trading range. It's important to remember, though, that this isn't the first time we've seen correlations between stocks and treasuries shift. In fact, they tend to ebb and flow depending on the macro backdrop. You can see here how the S&P 500 and the 10-year treasury have swung from highly correlated to nearly perfectly uncorrelated on a rolling one-year basis. Periods of rising inflation, strong growth, or changing interest rate policies could each alter these relationships over the short run. But over the longer horizons, treasuries, and bonds in general, continue to play a critical role in managing risk, especially when volatility returns to equity markets. So while the trade might feel different right now, and it makes for great headlines, history suggests that these few months have been more of an adjustment period, and we will have to see more before considering it a complete break from the past. So, as we come to the midpoint of the year, let's summarize where we are. U.S. equities have nearly recovered completely from the initial tariff announcements, as many of those have been walked back, and this recovery has been further supported by solid economic data and reasonably strong corporate earnings so far this year. Inflation pressures from oil and tariffs are certainly worth watching for their potential impact to the Fed's measured approach on interest rates, but it may be some time still before rates begin to come down. And while the role of Treasuries and the dollar may be under scrutiny in this moment, they remain among the most critical components of the global economic system and of building diversified portfolios. As always, if you have questions about your investment strategy or how these trends affect your plan, don't hesitate to reach out to your advisor. We are here to help you stay informed and confident in your positioning through these difficult market environments. Thanks for watching, and we'll see you next month.